Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back to another exercise tutorial from our tutorial series for chapter 3 of our managerial accounting course, ACCT 428. This is Mohammed Al Jabir, and in this exercise tutorial we're going to be looking at exercise 3-11A. So let's read the exercise together. It says, Owen Company makes a product that sells for $61 per unit. The company pays $37 per unit for the variable cost of the product and incurs annual fixed cost of $360,000. Owen expects to sell 20,000 units of product. Required, determine Owen's margin of safety expressed as a percentage. Okay? So let's quickly remind ourselves of the margin of safety formula, which states that the margin of safety which we can abbreviate to MOS if you like, okay, equals budgeted sales minus the break-even sales all divided by the budgeted sales. Okay, so that means we need to find two components. We need to find the break-even sales and we need to find the budgeted sales. Okay, what's the break-even sales? Break-even sales equals let's find it in units first. You can either use the contribution margin ratio to find the break-even sales right away, or typically I just find the units first and then just multiply by the selling price per unit. So that equals the fixed cost divided by the contribution margin per unit. Right? The fixed costs are 360,000, and we can find the contribution margin per unit from the difference between the selling price per unit and the variable cost per unit. Okay, so that's going to be $360,000 divided by the selling price $61 minus $37, which is the variable cost per unit. Let me make a little bit of space for the dollar sign. Okay. And now just run the numbers on a calculator. 360,000 divided by, open a bracket, 61 minus 37, close the bracket. Okay. And that's 15,000 units. Okay. From there, we can figure out the break-even sales, which we need for the margin of safety formula. And that's going to be N, or the break-even quantity, which we just calculated, okay, multiplied by the selling price, which is $61, right? So that equals 15,000 units multiplied by $61. Go back to your calculator. 15,000 multiplied by 61, that's 915,000. Okay, now we know the break-even sales, this part of our formula. We still need to find the budgeted sales. How can we find the budgeted sales? We're gonna assume that N equals the number of units that the company said that they expect to sell, which is 20,000 units. Okay, so budgeted sales is going to be the expected quantity, which is 20,000 units, multiplied by the price per unit, which is $61. Okay. Go back to your calculator. $61 multiplied by 20,000. That's $1,220,000. Okay. Now we got both of our inputs that we're going to use for the formula, for the margin of safety formula. Okay. The break-even sales, 915,000. The budgeted sales, 1,220,000. Okay. So that means margin of safety is going to equal the budgeted sales, which is 1,220,000, minus the break-even sale, which is 915,000, all divided by the budgeted sales again, which is 1,220,000. Okay. We go for our calculator one more time. So 1,220,000 minus 915,000. That equals 305,000 divided by 1,220,000. Okay. And that equals, so MOS equals 0.25, which is equal to 25%. Make sure you do this last step because the question specifically said, if you remember, needs to be expressed, the margin of safety needs to be expressed in or as a percentage. Okay? That's it for this exercise. This is how you can solve the last exercise that we have selected for you for this chapter, exercise 3-11A. I hope that you found this video tutorial useful. If you still have any questions, feel free to drop them down in the comments, and I'll try to answer each and every question. This was Mohammed Al-Jabir. Until I see you in another tutorial series, keep on learning. Take care.